Hi, everyone. On this session, we're going to talk about mortgage default insurance. What is it exactly, and how does it benefit borrowers? So what it is an insurance policy that protects your lender against loss if you were to default on your mortgage. So it's important to note that it's actually for the benefit of the lender. The insurance policy doesn't provide protection directly to you, the borrower. So the lender, if they have to recover on the mortgage, if you were to default and there was a shortfall, the insurance would cover that amount. Despite the fact it's a policy that benefits the lender, it does provide benefits to the borrowers as well. And the main one is that it allows you to get into a house with a smaller down payment. This lower down payment's most valuable for people that are new to the market, like first-time home buyers who may not have significant savings yet, because the minimum down payment on a mortgage otherwise, an uninsured mortgage, is 20% of the property value, which can be a really significant amount of money. With an insured mortgage, the minimum down payment can be as little as 5%. So you have to have a much smaller amount saved as a down payment to be able to buy a property. The actual math is 5% of the first $500,000 in value and 10% of the amount between $500,000 and $1 million. What are the qualifying criteria? Well, one of the main ones is it's only available for properties that are valued less than $1 million. If you're looking to buy a property that is greater than $1 million, it's not eligible for this kind of mortgage insurance. The amortization period cannot be greater than 25 years. Your gross debt service ratio must be less than 39%. That's the debt service just for the home itself. And your total debt service ratio has to be less than 44%, and that's your debt for the house and all other debts being factored in. At least one of the borrowers must have a credit score greater than 600, and generally speaking, investment properties are not eligible. This program that CMHC set up with this insurance policy was primarily targeted at people buying their primary residence. Who are the providers? Well, I just mentioned CMHC. They created this product decades ago. They're a crown corporation of the Government of Canada, and they are the main provider of mortgage default insurance in Canada. There are two private companies that do it as well, though. One is called Sagan, and the other one is called Canada Guarantee. So what does it cost? Because it can be fairly expensive. And this insurance premium is paid by the borrowers, even though the policy benefits the lenders. So if your down payment is less than 20%, you have to pay the insurance premium to get the mortgage. It's added to the mortgage balance, so it's not an out-of-pocket expense. So you don't have to worry about paying for it at closing, but you do pay it over time since it's now part of your mortgage balance. The premium schedule depends on the size of your down payment. So the smallest down payment of 5% that's allowed means you need to borrow 95% of the value of the property, and the fee for that is 4%. So it's pretty significant. As an example, on a $300,000 home with 5% down, that's $15,000. That means you're borrowing $285,000, and the premium would be 4% of that, which is $11,400. Pretty big number. So instead of having a $285,000 mortgage, you now have a $296,400 mortgage because the premium got added to that. So despite its cost, there are still great benefits to it because it allows you to enter the housing market sooner with less savings. And the other thing to note is insured mortgage rates are lower than other mortgage rates in the market. One last thing to note about the cost is in Ontario, Quebec, and Saskatchewan. If you're in those provinces, you have to pay PST, the provincial sales tax, on the insurance premium. So it's an additional cost just for borrowers in those three provinces. It can't be added to the mortgage, the PST amount, so you have to pay it out of pocket at closing. So when you're budgeting for your closing costs in those three provinces, you have to factor in that provincial sales tax amount to make sure you have enough money to pay for it at closing. If you have any other questions about this topic or anything related to down payments or mortgages more generally, please call us at the number on the screen. You can find us online at frankmortgage.com or scan the QR code here and get a direct meeting booked with one of our mortgage agents. We're here to help you out. Thanks for watching.